back to you. Joining me now in the meantime is Macro Mavens President Stephanie Pomboy, former CBO Director and American Action Forum President Douglas Holtz-Aiken. Still with me here is Jerry Storch, Mark Tepper, and Chris McMahon and Cheryl Casoni. I want to get your take, Stephanie, on these numbers. Obviously hotter than expected. Market's still higher and still expecting a cut in interest rates, even as inflation stays elevated and the consumer is slowing down. Your reaction?
Hope springs eternal, Maria. So we got to keep that narrative going. Facts to the contrary. Anyway, my broad analysis of these numbers is that they're really in keeping with what has been my thesis throughout here, and that is that we're going to have sort of a reacceleration in input price pressures, primarily driven by higher energy prices. And the question now for the markets is, what is the capacity of corporate America to pass those price increases along to consumers who clearly are increasingly spent up and lent up? And I think this morning's retail sales numbers underscore that. Getting back to a point that Jerry made that I think is so important, when you look at retail sales adjusted for inflation, this month marks 24 straight months where we've had zero growth in real retail sales. If you deflate the total level of retail sales by the CPI, it has gone nowhere since February of 22, which means that for 2 years, consumers haven't been buying more goods. They've just been spending more for exactly the same amount of stuff that they were buying 2 years ago. So that's not a, indication of a strong consumer, all no landing and soft landing narratives to the contrary. So my sense is that this is going to be a real issue for corporate profit margins, which is not priced into the markets at all. They're still expecting double-digit earnings growth this year. And of course, that pivot continues to be, something that they're pining for.
I thought that was extraordinary that Jim Grant just said the Fed could actually raise rates. I'm not expecting that either, but to hear Jim Grant say that, Mark Tepper, jump in here.
That'd be non-consensus. But look, when you look at what's going on with today's data, we have a consumer who came in weaker than expected on the retail sales number. We have inflation, which continues to prove to us month after month after month that it is coming in hotter than expected. And this path to disinflation that the Fed believes we're on, that investors believe we're on, that the Biden administration wants us to believe that we are on, it's a very bumpy path. And when you go back through history and you study high inflationary periods throughout history, globally, not just here in the U.S., across the globe, you find that in 87% of those cases, there is a second wave of inflation. I am incredibly concerned, given the recent trajectory of CPI data, and now you look at this hot PPI print, that we may be facing a second wave of inflation. And if you go back to what investors were expecting as far as rate cuts go, back on January 1st of this year, they were pricing in 5.7 cuts this year.
That's ridiculous.
As of this morning, it's down to 3.2. I don't see any way there's 3 cuts. I definitely do not believe June's going to be our first cut. Maybe 1, maybe 2 at the very end of the year, but I think it just seems like an uphill battle for the Fed to move forward with cutting rates at this point in time.
Chris McMahon.
Facts matter.
Yeah.
2 misses, right? The narrative can be the narrative, but facts matter. We've had 22 months in a row of an inverted yield curve, right?
Yeah.
That means a recession is coming. They closed 1,000 stores with Family Dollar last week, and they announced those 1,000 stores. This is real. This is significant, and I think we have to prepare. If we see an interest rate increase, I think it could create a significant downward pressure.
That's a great point about the store closings. I totally agree that is something to be aware of. Doug Holtz-Aiken, all of this as we face $34 trillion in debt. Your reaction to the numbers and where this macro story stands from your standpoint?
Well, I think the key has been the consumer. It carried the U.S. economy in the second half of 2023, and there are real reasons to be concerned coming into this report. We saw real disposable income growth drop by 50%. It was growing at 4% annually, dropped down to 2% in the most recent data. If the consumer falters, there's no other alternative to pick up the pieces. So I remain concerned about the outlook. I think the narrative about the easy path to 2% is overrated. We have inflation expectations at 3%. We have core CPI, core PPI, all in the vicinity of 3%. This is an inflation that is not yet back to 2 and is not getting there easily. And in the interim, we don't have a guarantee for growth. So the Fed's in a tough position right now.
Yeah, there's no growth plan coming out of this White House, frankly. And Cheryl, you know what Nancy Lazar said the other day? That it takes 10 quarters for rate cycles to really take place. So the Fed raised rates 11 times. We haven't felt that true impact yet. And we're going to start cutting rates?
Well, exactly. Well, I do think that we are starting to see the effects, and I'm glad that the consumer was mentioned, because I was digging into the retail sales report, and boy, I'll tell you, there's some really worrisome things in here as far as the consumer pulling back. I mean, and also going into the PPI, what I found was that 70% of that rise in the PPI report was gasoline prices, was energy. You don't have a choice. You've got to gas up your car, your truck, diesel fuel as well. Yeah. Also, the other things that are kind of staples in our lives, even in the PPI, I was looking at chicken, eggs, the jet fuel story. That's an airfare story. Beef, veal, and the tobacco products we saw rise as well. But this is an energy story, and this goes. I think these reports, if you put them together, you can see the consumer is faltering. They're paying more for everyday items. They're paying more for food. The services inflation story kind of is back in the headlines this week as well. And then anyway, all of that, the Fed can do what they want. I will tell you though that it looked like the futures pared back just a little bit when this report crossed at 8.
Stephanie, I've been making the point that rent seems to have stabilized. I spoke with Stephen Schwarzman the other day, the chairman and CEO of Blackstone, the largest owner of commercial real estate in the world, and he said, look, don't buy the hype, don't believe the headlines. Rent is actually down to flat. And I know it, he said. I'm the owner of the commercial real estate in the largest owner here. So rent is not an issue. But can a decline in rent offset continued elevation in food, in the other essentials, like Cheryl's talking about, energy? I don't think so. Your thoughts?
No, I agree with you, Maria. I mean, I think we have to put this all in context. We've had 2 years of rapidly rising prices for consumers, and what we're talking about is that the rate of change is slowing. So that's not alleviating a burden. And on top of that, we haven't even touched on the issue of debt service. I mean, it's not for nothing that consumers are delinquent on auto and credit card loans at the highest rate since right after the global financial crisis. So debt service for households has gone through the roof. It's the highest burden relative to income since that prior episode. And layer on top these higher costs of everything that they can't live without. And obviously you have a problem that's in no way reflected in the pricing of risk assets in the market. One thing I would point out, and this is a small anecdote, but I think it's an important one. A lot of the sort of bullish narrative, favorable narrative about the consumer says, look, during COVID, everyone went wild spending on goods, and now they've switched to services and experiences, and that's where they're spending their money. So forget about these retail sales numbers. Let's look at, what they're spending on travel and restaurants and all of that. Well, in January, the National Restaurant Association reported the weakest sales and traffic since restaurants were closed, since you couldn't go there during COVID. And the only time we were anywhere close to this week prior was during the Great Recession. Now, we have never seen restaurant traffic and sales this week. I mean, that is breathtaking. And so I think that's a really important shot across the bow about the health of the consumer and their willingness to continue to spend while they're paying these higher credit card fees, interest service, and prices at the gas pump.
Yeah, because it looks like the price increases have broadened out. It's forcing me to take out my inflation tracker again, and I've got it here after the CPI was released this week. Motor vehicle insurance, Mark, up 20%. Sewing machines, fabric supplies up 11%. Admission to sporting events, how about that one? Up 11%. So it's not just goods, but it's services. And again, oil underneath it all.
Without a doubt. And look, it's already been said, but the consumer is starting to feel tapped out. And to Stephanie's points, when it comes to credit card delinquency rates, I'm counting 19 states that have credit card delinquency rates in excess of 20%. The highest, Mississippi, is at 39.1% delinquency rate. on credit cards. So the consumer's been able to stay afloat by working 2 jobs. It's pretty tough when you're working 2 jobs to go and get a 3rd job so you can continue spending. They've been reducing the amount that they're saving out of their paycheck. They've been reaching for the credit cards. Credit card debt's over $1.1 trillion today, and now we're finding out they're not paying their credit card. So it looks like a pretty brutal situation as it relates to the consumer trying to keep up with all these inflationary pressures that continue to bog us down.
Jerry, your thoughts?
Well, building on some of this, 2 of the categories that have been driving the consumer sales last year are not strong today. So one of them is non-store retailers up 6%. That may sound year over year. That may restaurants. I know someone mentioned that earlier. The restaurant sales are up 6% year over year. All through last year, all through the year before, restaurant sales were up double digits. So if that slows down, then we're going to see the general slowdown, not just in consumer spending for things, but also for all their vacations and services and airlines and restaurants that we said was where they were spending their money. So this is a very weak report overall, consistent with the thesis the consumer's running out of money. All they can buy is necessities. And if I were an investor, I'd be focused on Walmart and Costco and TJX and other value-based retailers, because that's where the money's going to be spent on necessities.
Yeah, we spoke to the CEO Five Below on that. Value is really the first thing that consumers are thinking about when shopping. But Chris, we're talking about all these negatives, right? I mean, we're peeling back the onion here on this PPI number, and we're seeing real weak spots for the consumer and worrisome spots for inflation. Can you explain the capital markets to me, please? The Dow Industrials are up 170 points right now. We're near the highs of the morning. Your thoughts, Chris?
We have a lot of exuberance going on. There's no question about it. It's incredible. There's energy. The capital markets work. People are excited about it. But talking about Bitcoin, and everyone's excited about these things. But the reality is, I couldn't disagree more with Secretary Yellen when she's saying that the American families are saving $1,400 a month. They have that capacity, middle-class families. They're being pinched from every possible angle. The question is, when does the capacity end? Because I don't believe another relief is going to come. There's not going to be any more stimulus coming. So there's going to be more and more failures and repossessions of cars. I think there's going to be a kind of a period of reckoning as we get to the end of this.
Stephanie?
Oh, I absolutely agree with that. I mean, as you know, Maria, I've been firmly in the hard landing camp from the moment the Fed started raising rates. And my forecast hasn't changed at all, and this data only reinforces that, in my view. I think one thing that's interesting is that we've had this bifurcation, not surprisingly, between Wall Street and Main Street, and the impact that the rate hikes have had, and that's primarily because on Wall Street, they're so inured to this Fed put that they basically blew off the entire tightening cycle and said, this is all a temporary inconvenience, these higher rates. We're going to quickly get the Fed to pivot because they always pivot. So if we can just get from here to there, we'll be fine. And so you had this tremendous risk appetite in the face of higher rates, which we haven't seen before, with capital markets extending credit to weaker companies and enabling them to extend their maturities into the time when they thought the pivot would come. That has not been a luxury that has been provided to Main Street, and that's why you're seeing delinquency rates on auto loans and credit cards, etc., hit the highest since the global financial crisis. I expect that eventually those delinquency rates will be mirrored in the corporate sector on the default side once it becomes clear that the pivot ain't coming, and if it does come, it's not going to be sufficient to arrest the solvency issues that we're seeing unfold already.
Yeah, and got a lot of expectations there, certainly surrounding office space in terms of those defaults to come. Doug, what's most important to you right now in terms of the macro story of this report?
I think the most important question is what happens to business fixed investment. The CapEx numbers were really bad in the second half of 2023. They got revised up a little bit for the fourth quarter, and the durable goods orders haven't been very strong so far this year. So, the consumer has carried this economy. If the consumer falters, there's not going to be a CapEx boom to pick up the pieces. That's the recipe for a hard landing, and it's a concern that I've had for quite some time, and others share. It's really something worth watching.
It's a great point you make. Nancy Lazar mentioned it as well. She wrote a whole report on it that big capex and construction slowdown is unfolding. And we look at capex and durable goods orders, things like that, Mark, because these are big ticket items. And oftentimes when you see big corporations slow down in terms of their spending on capex, it's an important indicator for what's to come.
Yeah, and I guess it would lead you to believe that maybe the economy's getting ready to slow. And look, Maria, to your point on commercial real estate issues, I want to chime in on that real quick. Look, there's the second biggest building in downtown Cleveland. I know Cleveland might not be New York, but it's the second biggest building in downtown Cleveland. The current owner owes like I think 145 million or something on the building. There's negotiations right now to purchase that building for $50 million. I mean, you are talking about a substantial write-down just on the debt that's associated with that building, not to mention the fact that the building's worth a third as much as it used to be worth. So certainly issues there, but it seems like, you know, to Stephanie's points about corporate debt, I mean, you've got corporations that need to refinance their debt at higher rates. That's going to present a problem. We as a country need to refinance roughly half of our treasuries over the course of the next 3 years at likely higher interest rates. All of these things point to big-time headwinds for the economy to continue to move forward. And maybe, Maria, maybe that's why, in order for us to grow by $330 billion in the fourth quarter, we had to take out $830 billion of debt to finance that growth.
Yeah, it's a great point. And that debt is obviously front and center with $34 trillion in overall debt, and the amount of money it takes just to hold that debt is increasing with higher rates.
No question. You know, the president put out his budget on Monday, and that budget is a non-starter. Under that plan, interest costs exceed the spending of every agency, including the Pentagon, by the end of the year. We just can't go down that route. There has to be a real reckoning in Washington that it's time to pay the bills and not borrow everything.
Well, by the way, in that budget, he's got $5.5 trillion of new higher taxes. So you're talking about...
Maria, he has $7.7 trillion. It's one of the great budget gimmicks of all time.
Wait, $7.7 trillion in new taxes, Doug?
Yes.
Tell me about that,
Yes.
because I'm reading it
So
as
if you look at
$5.5
the
trillion, but you're saying it's much more. How do you arrive at that number?
Yeah. So if you look at the CBO baseline, which is current law, and you look at the OMB baseline, which is the president's starting point, they differ by 2.8 trillion in revenue. So there's 2.8 trillion in taxes the White House is not even talking about. They're willing to talk about the other 4.9, but that's a ton of taxes in that budget. That's a very dangerous economic plan.
Well, he's telling us what a potential next 4 years would look like, that's for sure. Much higher taxes on an economy that's already stretched, Jerry.
Oh, absolutely. I think it's a very tough environment right now. These numbers show it. I don't want to be the boy who cried wolf. I've been saying this for some time. I don't know why everyone wants to paint this more positively than it's been. And even a lot of the improvements we've seen, as I've told you before, are due to the seasonality factors using to adjust some of this data, which made it look a little better than the last year than it really was. And now we see the real numbers as they're coming out.
Yeah, but on the other hand, Chris McMahon, election years are usually good years for the stock market. Does that play into your thinking?
It does. We think there's still some room, believe it or not, in spite of all of this reality in the equities market. I mean, it was so concentrated. The Magnificent Seven did everything last year. There are some value stocks that we think still have an opportunity somewhere, right? And we think it's in value stocks. In spite of, you know, I agree with what Jerry just said. I think there's some real dark clouds on the horizon, particularly in retail. But in spite of that, we think, you know, hope springs eternal, right? And these are election years, and we think it's going to have some opportunity.
Cheryl.
Well, you know, I want to bring up something else in all of this. I was reading a Piper Sandler report from this morning about the labor market. And basically, Piper Sandler is making the argument that the labor market is not as strong as it appears in first blush. You know, we get these jobs reports out all the time. And what basically they're saying here in this new report is that you're going to see recessions in states where basically blue states, but it's states where like California and New York, you're going to see recessions happening in those states, and then in more of the red states, you're not seeing recessions because that's where the population fled to. And so the jobs numbers are being actually kind of held up and bolstered by the states where everyone, like, think about Florida, think about Texas. national recession. We don't even talk about it anymore, to be clear, these days. But if you have a state-by-state recessionary environment, that's also obviously bad for the economy, and it does not explain the bullishness that the market is showing us right now.
Well, that's a great point in terms of looking specific states and where the vulnerabilities are. Stephanie, I know you've been negative on this market, expecting investors to catch up with your thinking here, but it's not happening so far. Are there areas that you think are places to hide if, in fact, we do see a broad sell-off as investors recognize that this economy has some serious cracks in it?
Well, I am bullish on energy and for geopolitical and woke reasons or anti-woke reasons. So that's an area. But my primary core position has been gold throughout. And it kind of dovetails off of something that Douglas said earlier as relates to this whole conversation around the untenable fiscal situation that we have. I believe that the balance sheet is going to be where all the action is, and the markets aren't really focused enough on that. Everyone's so squarely focused on when they're going to cut rates and how much. But I think the balance sheet is going to be the bigger story in the longer term for sure, because there is just no way that the Fed can continue QT, but indeed will have to pause and re-up QE. There is no other way that we can sustain the Treasury market other than having the Fed go back to becoming the marginal buyer. When you look at the capital flows or the lack thereof by our one-time foreign creditors, that's where the action's going to be, and I think that will have devastating consequences for the U.S. dollar. And that's why I'm long gold, to say nothing of it being sort of an anti-risk asset. So that's where I would be. I wanted to quickly, if I might, add to Cheryl's point on the state and local situation, because I've been watching state and local tax receipts, and they are negative year on year. And you've seen many states like California, et cetera, flip from surplus to deficit in the blink of an eye. So tax rates are going to go up in those states. Many of those states are already talking about that, which will just accelerate the flight and the job transfer from those states to the red states that people are fleeing to. So I think we will see those trends accelerate, especially if the economy slows or much less has a hard landing and those tax receipts implode, as I expect they will.
Wow, that's a great point. And Doug, I wasn't even thinking about the state level taxes because I was focused on the president's $7+ trillion budget and his ask of $5.5 trillion, or as you say, $7 trillion of new taxes.
Yeah, I mean, one of the things that was a big surprise was that a lot of states managed to cut their taxes during COVID, and that was due to the enormous amounts of money that got shoveled into the states from the federal budget. We're now seeing all that reverse, and that's going to be real pressure on the states. Their budgets are tight. They've got a lot of spending promises they got to meet. That's part of the picture that just says people are going to get hit from every direction. Higher state taxes, high inflation, their disposable income is not growing as fast. It's not a great outlook for the consumer, and that has been the linchpin of the growth so far.
Yeah, it's important to focus on that consumer. And Jerry, your thoughts in terms of what's most important that we need to continue to look at the right metrics in terms of what's telling the story of the consumer.
Look, it's absolutely slowing. It's been slowing for several months. They even revised, you may have noticed, the January numbers down in the latest, in this release, and no one's talked about that. I also see automobile sales, they're barely up, and that's on a real basis. And if you think about the fact cars certainly cost more than a year ago, then we're all over that restocking phenomenon where automobile sales are driving part of the growth we were seeing in the economy. So it's a very difficult environment. Inflation is breaking the back of the American consumer. All the money has to go to food and has to go to necessities, and there isn't a lot left over.
Yeah.
It's not like the end of the world, but it's a very tough period.
Mark, these are the essentials. These are the essentials. You're talking about food and oil.
Yeah, and Stephanie mentioned, tax receipts being down. Cheryl mentioned the issues with the labor reports. I mean, when you look at all these things that are going, there's certainly a big issue between Main Street and Wall Street, just as Stephanie mentioned. I mean, look at small businesses. Every single day that NVIDIA is making a new high, small businesses around the country are struggling. Small business optimism came in earlier this week at 89.4. It bottomed at 89.0 at the depths of COVID. Small businesses are incredibly pessimistic. Small business hiring plans have fallen off a cliff. So, I mean, you take all that stuff, and when small businesses employ roughly 50% of the workforce, you can see that there's a big difference between Main Street and Wall Street.
Yeah, and you know what's going to really hurt small business is an increase in regulations. There's that potentially coming, Chris.
It could be catastrophic. There's no question about it. People, any kind of debt service for a small business, everybody's looking to tighten up their workforce. He put regulation on top of that, and this could really spell really a real significant downward pressure for the economy going forward.
So, Doug, this climate change agenda, where we are, Xing out fossil fuels, jamming electric vehicles down to everybody's throats, it's got a two-pronged strategy here, because it's not just the fact that you're eliminating the oil independence of America, but you're also adding on lots of new rules for corporate America.
An enormous regulatory burden. As you know, we track this at the American Action Forum. The Biden administration has put in place $450 billion of regulatory costs already. An unbelievable pace, faster than anyone. And if they follow their plans in the first quarter of 2024, they'll add another $250 billion. It's astonishing. This is an enormous headwind to growth, and no one seems to notice it.
Yeah, it's an important point that we'll keep folks on. Great conversation, everybody. I so appreciate everybody's time. Thank you so much to Jerry Storch, Stephanie Pomboy.